In this example, we'll be doing practice exercise 14.4a that can be found in your textbook on page 652. We are going to be journalizing the entry required when issuing a bond at a premium. We will be also doing practice exercise 14.5a, where we will journalize the interest payment and amortization of the premium. The example tells us that on the first day of the fiscal year, a company issues a $4 million, 6% 5-year bond that pays interest semi-annually of $120,000, and that we received cash of $4,175,041. The company that's issuing the bond is the one that will record the liability. When it shows the $4 million, 6% 5-year bond that pays interest semi-annually, this is our contract that we've agreed to with the bondholder. We've agreed that 5 years from now, we will write them a check for $4 million. We will also give them $120,000 every 6 months for the next 5 years. So on January 1st, we're going to issue the bond. We're issuing the bond for a loan of cash. And they told us that we issued the bond and in return received $4,175,041. Our bonds payable, our liability, always has to be recorded at the face value of the bond. And the face value of the bond was $4 million. Your bonds payable account can never be recorded for more or less than the face value. When we compare what our liability is, the $4 million, to how much cash that we received, which is the $4,175,041, we know now that we have what we call a premium on bonds payable. We are receiving more money than what we have to pay back in 5 years. So we have a premium of $175,041. Remember, with every bond, there's 2 pieces to the bond. The face value, which is what we're just dealing with here, the $4 million, and the interest payments. At the end of 5 years, we'll be paying them back less than what they gave us today. However, we'll also be giving them interest payments, which is separate than that face value. We are now going to journalize the first interest payment and the amortization of the bond premium, and they tell us to round to the nearest whole dollar. Let's assume that our first interest payment is due on June 30th. Because we have to pay interest on a loan that we have, we record interest expense. It's costing us more than just that $4 million that we owe 5 years from now. We have to pay back the $4 million plus semi-annual interest. They tell us in practice exercise 14.4a that we're paying semi-annual interest of $120,000. That is what we are contractually obligated to pay our bondholder. We cannot pay them any less than that amount. We also have to amortize our premium on our bonds payable. And we do that by simply taking the total premium and dividing it by the number of interest payments that we are going to make over the life of the bond. Notice that our premium on bonds payable on January 1st went on as a credit, so it will be reduced with a debit. And we have to send the bondholder a check again for that total $120,000. We want to amortize a discount or premium on bonds payable so that by the time the due date or maturity date comes, there is no premium or discount left, and all we have to do is pay back the face value. So let's calculate our amortization of our premium. Our premium in total was $175,041. In practice exercise 14.4a, they told us that it was a 5-year bond, but we're looking at how many interest payments we have to make. And they tell us that we make semi-annual interest payments, which means we make 2 interest payments a year. So in total, we'll be making 10 interest payments, which means that we'll be paying $17,504 as a reduction to our premium on bonds payable. The amount of interest expense that I'm going to record is simply the difference between the amount of cash I'm sending to the bondholder that I'm contractually obligated to send and the premium that we are amortizing. So for this premium, we are only going to record $102,496 in interest expense. Notice that it is lower than how much cash we're actually sending. This is because the amount of cash that we'll give them in terms of the face value on the maturity date is less than how much cash they initially gave to us.